Cadbury finally accepting a new $19.7 billion offer from Kraft, ending a 4-month takeover struggle that was quite dramatic. Donald Yacktman is founder of Yacktman Asset Management. He's here with some perspective on the deal. And Don, great to have you with us to talk about this development. Essentially, Kraft finally got the deal done, but they had to pay a price for it.
That's true, although the way the deal ended up being structured, they put in more cash and less stock, which I like to see. This will make it, on an earnings per share basis, actually be accretive next year.
It should be, and it's all good. I mean, we talked to Mario Gabelli. He's very happy with this deal. But did we need to go through this 4-month back and forth where you saw quite some strong words coming out from people like Roger Carr at Cadbury?
Probably did, because there are a couple of reasons. One, it reminds me a lot of the Anheuser-Busch one that was done by InBev about less than a year and a half ago. You know, similar kind of thing. I mean, the shareholders had to be comfortable. The management and the shareholders had to be comfortable. There wasn't some other suitor ready to pay up more, and there wasn't. So, and I think Kraft wouldn't start with their highest possible bid, so they always left themselves, I'm sure, a little room.
Right.
And it's a great fit. I mean, Kraft, for years, I've said what they needed was more international exposure, more products that can be distributed on a worldwide basis, more international exposure. I mean, if you're going to become a worldwide food company, this was a great synergistic acquisition. Now, it's not without risks and everything, but it looks very good for where I'm sitting right today.
Before we get to the risk, but Don, I mean, in your sense, though, I mean, you've watched a lot of M&A activity in your years. Is this the way deals are going to get done?
Well, there aren't many huge deals like this that can be done. I mean, this is, you know, many billions of dollars. And but I think this has been going on for a long time. This is not something brand new. Right.
Okay. And the risk, Don, you mentioned. I do want to hear from you. Aside from the positive, what's the one risk though that you see for this deal?
Well, I think there are more than one risk. I mean, first of all, the products, while they have higher margins, don't have as high a market share. And anytime you enter into situations where, now you got to deal with the politics of the fact that you've got a U.S. company and a British company, and British always want to retain employees and everything, just like, the converse would be with Anheuser-Busch. The people in St. Louis and the U.S. want to maintain employees. So, I mean, you've got all sorts of little things that have to be worked out, but overall, I think it'll work, and I think it'll work probably quite effectively.
Okay.
And she may have been a little lucky because of interest rates being low and her stock price having jumped, and Mr. Buffett basically saying, "Hold the line," and that allowed the stock to come up. So overall, again, I'm pleased.
Okay. All right. Well, we're going to certainly be watching more about that. Don, good to talk with you.